I used to tell people I have 3 secrets to building wealth and having a comfortable retirement. And the very first one was, it's not enough to just save. It matters how you save. And Fidelity just came out with a report, and for the first time, a big institution is actually talking about this. And I want to start off with one of the charts they have here. And this is if you saved $100 in 1980, depending on how you saved it and how it was invested. This is in 2024. And no, this is not, invest in Apple stock. This is just easy, non-company specific. In one strategy, well, first off, inflation would be $413. Depending on how you invested it, the next strategy would have about doubled inflation. You'd have about $700. And the third strategy is you'd have about $2,000. But the number one strategy, and this is a strategy that any of us can do, instead of having $700 or $2,000, you'd have $17,000. So let's talk about why Fidelity feels that most people are saving the wrong way and how we should think about saving instead. And first, we're just going to go through this in the order that Fidelity has it. And the first one that Fidelity says people make a mistake with is avoiding investment decisions due to uncertainty. And I agree with this. Unfortunately, the stock market is uncertain. Like right now, we're at or near all-time highs as I record this. Now, what was it? 4 months ago, the market had gone through almost a 20% correction from high to bottom on concerns about new tariffs being put into place. So it's either, you're worried about, the way the world has traded with each other has changed dramatically in the last 6 months versus over the last 50 years. So you're either worried about that or you're worried about valuations in the stock market. And boy, things seem pricey right now. So there's always uncertainty, but that fear of uncertainty can cost us a lot of money. Let's go to number 2. And number 2, Fidelity says the mistake people make is many people are always expecting the next shoe to drop. Either something bad is currently happening, or if it's not currently happening, it's about to happen. And in the industry, we call those folks permanent bears. Bears are people that think the stock market's going to go down, or perma bears for short. And the problem with being a perma bear, this is a stock chart of the S&P 500 since 1985. And you can see all of these concerns that, for me, I'm old enough to remember Black Monday, which I believe was 1987, October of 1987. And that was the biggest one-day drop in the stock market. I think it was like 20% in one day. And you can see that's the very first one here, Black Monday. It barely shows up as a blip, but you can pick which concern you have. Look at where the pandemic began and look at where we are now. When the pandemic began, before the drop, what were we at? A little over 3,000 in the S&P 500, and now we're over 6,000. So being a perma bear can be a very expensive thing. Okay. Number 3 is waiting for cheaper valuations. We talked about that. It always feels that the stock market's overvalued. And when it doesn't feel like the stock market's overvalued, it feels really, really scary out there because it means there's a correction taking place. Those of us that are old enough to remember the great financial crisis, 2008, 2009, when things got reasonably priced, a lot of folks were on the sidelines because it also felt like, it was the darkest dark, and it looked like things could really unravel the financial system as we know it. It looked like it could collapse. Okay, number 4, and this is what I got the open from, where I gave the different investments. So now we're going to talk about these different investment strategies. Number 4, Fidelity says, if you save, but you hold too much in CDs and other short-term investments, that can hurt you. And this is how $100 grew. So the first one was inflation from 1980 to 2024. Inflation would have taken that $100. In today's dollars, that'd be $413. 3-month treasuries, so treasuries are issued by the U.S. government. So that would be considered one of the world's safest investments, would be 3-month treasuries. That would have grown almost double the rate of inflation, which frankly surprises me. It would be just under $700. And then if you were in bonds are debt that companies issues, you would have had about double of what the world's safest investment, the 3-year treasury is. You'd have almost $1,800. But if that money had been put in the S&P 500, that would be worth over $17,000. So how you save is important. Okay, number 5, the Achilles heel is trying to predict the future. And, there's always news headlines that will either agree with our current point of view, or there's news headlines that will scare us. And neither one of those do us justice. In fact, for most of us, what we should be doing instead of trying to predict the future is just come up with a long-term asset allocation. What percent of your portfolios in stocks, what percent's in bonds, and stick to that over an investment cycle unless something in your life changes. Oftentimes, people change their asset allocation because of what's happening in the stock market. But that oftentimes is how people end up buying high and selling low. And so if your life hasn't changed, if you still have a good, stable job, you're not worried about that. If, you're not buying a new home, if your time horizon has stayed relatively the same, come up with a good asset allocation and stick with that through good times and bad times. I should say this is not financial advice. And the question I get asked a lot is, hey, Azul, how do I come up with a good asset allocation? And I would say the first one, the gold standard is to work with a fiduciary financial advisor. I know a lot of my audience would prefer to do it themselves. If that's you, it's good. It's okay to do it yourself, but it's not okay to build the model yourself, which is essentially using Excel or Google Sheet. It's going to take dozens of hours, if not hundreds of hours, to build your own plan yourself. And why? There's software that's developed that's very reasonable that will do a great job for it. The software that I like used to be called New Retirement. It's now called Bolden. You can use the link showing up right here. If you do, you'll be supporting the channel. I am an affiliate, so thank you. Okay, number 6, and this is a big one. This is one that I see retirees miss all the time, which is not factoring taxes into their investment decisions. Taxes end up being one of the biggest expenses that we have in retirement, and you can make it worse by not thinking about taxes in your investments. So how do you do that? This is a case where the dollars are big enough that I think working with a CPA doesn't have to be crazy expensive, but oftentimes it can save you, spending $1,000 with a CPA can save you thousands of dollars in taxes. Okay. And then, letting the perfect be the enemy of the good. My mom used to tell me that I'm a perfectionist. So my mother used to tell me that, and I've had some bosses tell me that as well. And analysis paralysis can be a challenge for any investor. And, that's the nice thing about having your own software, something like Bolden that I mentioned earlier, is you can do scenarios and look at things. But ultimately, once you have enough information to make the decision and move on, and don't constantly second guess yourself, because that second guessing can cause angst and can cause you to make changes that you end up spending a lot of time, and it ends up costing you money because you lose money. So why would you do that? And the other thing is, why would you give up the youth of your senior years? The years between 50 and whenever you lose your health. Hopefully that's 75 or 80, but why would you give that up if you don't have to? And that's why I made this video here. Why waiting to 65 to retire might be a big mistake. Thanks for watching this one. I hope to see you in the next one. Bye-bye.